Hello, this is Corner Invest. Today I'll be talking about the Max 7 stocks that I've been buying and some other stocks as well. So let's look at the first stock over here, which is Google. So Google is currently trading at $165. It is down around 22% from all-time highs. And yeah, I believe Google is presenting a decent buying opportunity right now. So let's go into my bull thesis as well as my bear thesis for Google. So let's look at Google over here. So my bull case is this. Google has been trying to diversify their business out of their main portion, which is search, and they've been doing so via Google Cloud mainly as well as YouTube. So Google Cloud is one of the highest growing segments in their business. In fact, it is the highest growing segment. It is growing at around 30% year on year. And my bull case for Google is that they can continue growing their Google Cloud at this pace, especially with the increased need for all your cloud computing and all that. And then they have an extremely durable YouTube business as well, which is growing at around 14% every single year. And YouTube has no innovation risk whatsoever. They're just there. They're just sort of like a toll gate between your advertisers as well as your creators online, like myself right here. So YouTube is an extremely underrated business. It doesn't deserve just a 20 PE. That's how I feel. And you have the Google Cloud segment as well, which is growing at around 30%. I don't think it is deserving of a 20 PE. So my bull case for Google, other than that, is that the search portion just continues with its dominance. So Google search now currently makes up around 54% of their revenue, and that is a slight problem for Google because the search dominance may be weakening already. You have all your different LLMs which might take market share away from your Google search. But if you're to just look at the valuation for Google as well as the fundamentals of Google, I think this company is doing quite well. Sunda is definitely doing well. Look at the revenue, 13% year on year, and then net income growing 36% year on year. That's just incredible, and it is currently trading at a relatively low valuation as compared to the past. So 15 times operating cash flow, price to free cash flow of around 27 times. Take note that this is in a capex upcycle as well, so it is highly elevated as compared to the past. And then you have your price to earnings ratio, which is around 20 times. So I think for Google, the main two bear theses will be number one, the Google search dominance weakening, and number two, the AI capex spend, which is the same for all different other hyperscalers as well. So for Google over here, just to look at the metrics, so like I said previously, Google Cloud is growing at 30% year on year, YouTube 14%, and they make up around 25% of revenue now. They will make up around and they now make up around 15% of net income. So if you have Google Cloud that can continue improving their margins over time, this 15% number could easily grow to around 20%, 30%, maybe even 40% next time as Google search reduces the dominance in the Google empire. So yeah, as you can see, Google is currently trading at 20 times earnings. That's just the lowest in the past few years. And if you're to talk about the moat of Google, maybe the moat could be declining. Maybe the YouTube, the Google search empire could be weakening already. But if you are to look at all your different Max 7 companies like your Microsoft, your Amazon, what they've been doing is they are diversifying out of their core businesses. I don't really agree with it because that's not what a core quality business should be doing. They should be focusing on their main business instead of diversifying out. But for all your different Max 7, all your different tech companies, that's the problem with tech because they have to constantly innovate so that they can push and drive for growth. Unlike Apple, so if you're to see Apple is the company that has diversified the list away from their core business, which is selling your different iPhones, iPads, and all that. And that is the problem with Apple because they can't drive growth now because they're not diversifying their income streams. But for Microsoft, for Amazon, for Google, what they've been doing is they're trying to diversify out of their core revenue stream, which I disagree with, but it is what tech has to do. So that's the problem with tech, and if you're investing in tech. So I think it is not a big problem. Maybe they can continue doing so that they can diversify out of search. And at that point, I think this business trading at 20 times earnings is very reasonable right now. Next company is Amazon. So Amazon over here, I have a few bull case over here. So bull case is just a margin expansion for this company. It's business as usual for Amazon and a shift from growth to profitability. So the new CEO, the Andy Jassy, he's a lot more focused, he's a lot more pragmatic. He wants more profitability as compared to Jeff Bezos back in the past, where Jeff Bezos, he just wanted the greatest market share in everything. So he will sacrifice profitability for growth, and that's why people will always use the price to operating cash flow for Amazon instead of the price to earnings ratio, because they will often suppress their earnings to continue growing and growing and growing, which was what Jeff Bezos was doing. But for this new guy over here, Andy Jassy, he's a lot more pragmatic. He wants more profitability, he wants more shareholder returns, and that's what I like to see. And so the bear thesis for Amazon is simply just two things. Number one is just consumer weakness over the years. So I have this thing over here. This one is the consumer sentiment. So as you can see, consumer sentiment has been slowly grinding on a downtrend. I would say it's more of like consolidating. It's been consolidating over the past 2 years already. And retail sales as well, which is up here. Retail sales has only fallen negative once in the past year, which is in January, because of the tariff expectation, which led to people front running and buying a lot more in December, as well as the seasonality. So I don't think these two are a big worry now, and it's a bit hard to predict consumer sentiments as well. So I don't really like to put this in my analysis. Next one is just AI capex spend leading to depreciation and amortization. So Amazon is projecting $100 billion in capex spend in 2025. But if you're to just look at their capex spend and the returns for it, they've been able to increase their ROIC from around 5% to 16%. And that's what you want for your companies. If you want maximum returns, maximum parabolic returns, you want your companies to spend on capex, and for that capex to have returns. And that returns is normally measured by return on invested capital or return on capital employed. So Amazon increasing their ROIC from 5% to 16% in 2024, all while increasing their capex. I don't think the capex is any issue right now, unless it hurts profitability in the future, where they have a lot of depreciation and so on. Next one. Amazon margin was 2.7% in 2023, excluding AWS, and it was 5.4% in 2024. So I expect them to continue improving their margins over time. And if you're to just improve the margin, let's say the margins improve by 2% only in 2025, that is already a $225 stock based on my calculation. So it's around 10 to 15% undervalued at this point. And analysts are projecting around 20% EPS growth over the next few years. And at 35 times earnings, it is undervalued based on the PEG ratio. So PEG ratio of less than 2 times, this quality business is undervalued. Next one. And I think the only bear thesis for Amazon is just the AI capex spend, which would lead to your depreciation. The consumer spending is cyclical at times, but it's a secular growth trend. People won't stop spending money. And I think factoring in consumer sentiments into my analysis to time the bottom and time the top is a bit hard, because it is arbitrary. It's like interest rates. No one can predict where it's going to go. So for me, Amazon is a decent buy right now. That's another company that I've been buying into. Last Max 7 company is Microsoft. So Microsoft is easily one of the highest quality Max 7 companies out there. It has 3 main business lines: your Microsoft 365, your Azure, as well as your personal computing space, which is your Xbox, and then your Windows. So the Microsoft 365 makes up around 40% of the revenue. Azure makes up the other 40%, and then you have your personal computing space, which makes up around 20%. Personal computing is the slowest growing one. It's growing at around a low to mid single digit, so 3 to 5%. And then you have Microsoft 365, which is growing at around 10 to 12%, and then it's a recurring revenue business. So you don't need too much growth for that. All you need is just an increase of around 10 to 12%, and then you just improve margins here or there, and that's a 15% earnings growth in this segment already. Next one is the Azure business. So Azure is growing at around 19%, 20% or so. So I think Azure, which is their cloud providing platform, is incredible. It's like Amazon. They're able to bundle they're able to bundle everything into one model. So you have your Microsoft 365 as well as your Azure. They bundle everything and then they sell it as a product to all your different consumers and all your different companies and so on. So I think for Microsoft, their ability to bundle everything is actually a tailwind for them, because if more people need Microsoft 365, they will naturally sign up for Azure, and this leads to sort of like a cycle of increased demand for their products. And the only bear case that I see from Microsoft is simply just the AI capex spend. And over the past few years, if you're to look at just the valuation, it is currently below its mean in terms of valuation. But the valuation was of course a bit elevated because they were growing much faster. But I think Microsoft right now is between 5 and 10% undervalued. I want more of a discount. My next add will be around $340. That will be where I seriously add a few percentage points of my total portfolio into Microsoft. Let's talk about some other companies that I've been buying into as well. So the first company is S&P Global. S&P Global is a duopoly in the credit rating business, and there are other segments, which is your market intelligence, your mobility, as well as your commodity insights. All of them are growing at around 20%. All of them have around 20% of the market share in each segment. So credit rating is dependent on rates, and I expect rates to go down based on Trump's actions, not so much his tariffs, but his intention to bring inflation down. So if interest rate goes down, what that leads to is more people will raise debt because debt will be cheaper. And when debt is cheaper, people will need to have more credit ratings, and that's a tailwind for your S&P Global. So the valuation right now is 27 times price to free cash flow. I think it is extremely reasonable for a quality monopolistic business like this one. In this case, it's duopoly, but it's an extremely high quality business. And if you're to look at just the fundamentals over the past few years, it's just incredible for this company. So for S&P Global over here, why do I like this company? There are a few bull theses for this one. So in 2028, they're projected to increase their debt wall. As in, no, the debt wall is projected to increase all the way until 2028, which is the debt maturity. So when there's debt maturity, people want to have more credit ratings because they need to get more debt. And so I expect the credit rating portion of this business to continue growing all the way until 2028. And after that, then it could decline, but the markets are forward looking. So there'll be other mitigation methods that S&P Global will use at that point. And then next one, capital allocation is great. So they devote around 80 to 90% of their free cash flow into buybacks and dividends. So if you were to think about it, the returns for this company is basically just the free cash flow multiple, the free cash flow yield plus the earnings growth over the next few years. So they are currently trading at around a 3.7% free cash flow yield. So you take that 3.7% plus the net income growth, which is around 12 to 15% over the next 3 years, and then maybe 12% over the next 10 years. That could easily be a 15% CAGR for this company already. So management is still focused on their core businesses. They divested weaker businesses in IHS Markit after acquisition, like their engineering solutions, and they sold McGraw-Hill as well, which is their education business back in 2014 to focus on their core business, which is their financial services. So I think management is extremely pragmatic. They know where their core business is. They sell their weaker businesses and then they keep everything inside their core business, which is like what I like to see for all the different managements over here. And I do believe that S&P Global is one of the only companies that I'm confident could stay here for the next 20, 30 years. Not even your Mac 7 companies could rival that, because your Mac 7 companies, what they need is they need constant innovation. But for S&P Global, they don't need innovation. All they need to do is just act as a toll gate and just sit there and collect money as people raise debt and all that. So they hold a 45% market share of the credit ratings. They don't need any more capex, meaning to say they don't have to spend extra money to increase their market share. They don't have to spend extra money to innovate and create new products. All they do is they just sit down there as S&P Global and they collect money from credit ratings. Same for Moody's. So that's why I love these two businesses. They are incredibly capital light. They're incredible businesses. Last one, MSCI. So MSCI basically what they do is they have three different portions. The main one that we'll be focusing on is the asset linked fees. So the asset linked fees is basically what they make from all the different MSCI ETFs. So you have your MSCI Emerging Markets Index, MSCI China Index, and so on. And I do expect the asset linked fees to increase just based on the past 3 months performance for Q1 of 2025. So in the past 3 months, all the different international markets have been outperforming the US market. And so I do expect more inflows into those segments, which will lead to more profits for MSCI if you're looking short term. But if you're to look at this from a long-term perspective, this company is just the king of international indices. It grew revenue in 2020 and 2022, even in down years. And I do expect them to continue growing their revenues at around 10 to 12%. And with revenues growing at around 10 to 12%, that could be earnings growth of around 12 to 15% already. And if you're to look at just the EPS metric itself, that could be a 15%, as they spend a lot of their money, same as S&P Global, on buybacks and dividends as well. So I love these two companies. They're not trading at extremely cheap valuation. So MSCI is trading at a 40 times of earnings, a 30 times price to free cash flow. But for me, it's worth it to pay up for businesses as high quality as this one. So MSCI is one of them. And then the other one is S&P Global as well, which is trading at around a 40 times earnings and around 27 times price to free cash flow. So for me, I'm buying into these two businesses. I hope they drop a lot more so that I can add a lot more to it. These two are incredibly monopolistic business that I have great confidence in. Hopefully this video has been useful, and yeah, leave some comments so that I can reply to them.